We have another red day in the market so far, something that we have become well accustomed to in 2025, and we can clearly see that investor sentiment is still sitting fairly low in fear, although as we've mentioned before, it is looking a lot better than the low single digit extreme fear from just at the beginning of the month. But we are also noticing a lot more negative news, a lot more issues with tariffs. We can see that some of the Chinese freight ship traffic to some of the busiest ports are seeing some very large drops. This is just one of the effects we have noticed from tariffs and the ongoing trade war between China and US, and this is ultimately leading to a large demand plummet. And whilst we're not seeing the effects right now, this is something that could catch up with us very soon. And we can also see this in the agricultural space. In fact, China are now starting to stop buying products, something they did in quite bulk, as we can see a number of products from pork to hay, straw and lumber, something as we said will continue if agreements aren't reached. And this isn't something new. In fact, we've seen this from a few weeks ago. It's just at the moment these tensions are ongoing. Nothing has been agreed, although we are led to believe that in the background the US and China are having talks, something that Beijing are denying while Donald Trump is saying they have come to the table. But if something isn't agreed very soon, we can see irreversible damage perhaps to many businesses, not just in the US but also China as well as the other countries that this does affect. And we can ultimately see the effect it's had on the stock market itself. Many companies down year to date significantly. Pretty much every single company in the Mag 7 down double digit other than Microsoft and Meta. But you can also note some companies have actually performed fairly well, and perhaps a shout out is due to Warren Buffett, Berkshire Hathaway, which is up 16% in 2025. This is also adding to the anxiousness, the fears of consumers, all of this uncertainty, whether or not we're going to see inflation go back to the very high levels from not that long ago, has left consumers confused. Some are spending more right now as they believe prices will be a lot cheaper today than in a year's time, in a couple of years, whereas others are doing the complete opposite. And we can see sentiment just continues to move further and further down, from anxious to petrified, as we can see here. Maybe not something you can see yourself, but we are led to believe by the media that consumers on a whole are extremely worried. And perhaps you could argue this is true. We are seeing this now in earnings call. We've highlighted this when we did the deep dive on Pepsi, where in fact on the earnings call they said that consumers are buying less of their products, moving away to cheaper alternatives. And we can also note this is something that was corroborated on both Chipotle as well as Procter & Gamble's latest earnings, so perhaps something we should consider. But it's not just the obvious companies that you would expect to be hit by tariffs. We can also see from Alphabet's latest earnings call, they also noted that they're obviously not immune to the macro environment, and perhaps you should take a look some companies you do own that maybe aren't that obvious in terms of the effects of tariffs. If we see the global market, the global economy continue to deteriorate, then pretty much every single company could be affected one way or another. But at the same time, it does give a very glorious opportunity for longer term investors who want to seek out high quality companies that are trading maybe not at very low valuations, but at least attractive ones for the longer term. And that is something we want to dissect in today's episode. Some of the companies that you see now in terms of a forward valuation are ones that we do believe over the longer term will return very large gains. It doesn't mean that if you buy them today, buy them tomorrow, they're not going to go lower. No one has a crystal ball, but ultimately the aim should be to buy high quality companies at attractive prices. Now we're going to cover 6 that we do believe are significantly undervalued, and we're going to explain exactly why. Kicking off with the king of AI, Nvidia, which is up nearly 30% over the last year. But just today in the market it is down around 4%. Year to date also down double digit, negative 20%. 1/5 of their market cap just wiped off in a matter of months. Over the last 10 years, longer term shareholders probably wouldn't worry too much. They're up more than 20,000%, massive outperformance of the S&P, trading towards the lower end of the 52-week range, quite away from their all-time high at above $150, with a strong buy from Wall Street, a buy from Seeking Alpha, and we can highlight their forward valuation of 24 is significantly below their 5-year of 42.9. This is what we would say is a severe undervaluation signal, and this is also confirmed when we take a look at this methodology, which tells us a company is severely undervalued when there's disparity between where the company sits and the blue tunnel. The blue tunnel effectively indicating the fair price. Nice to see it increasing over time. That is ultimately what you want to see. But for Nvidia, pretty much from the back end of last year, it's only been getting more and more undervalued. But do bear in mind, we are anticipating their earnings over the next few weeks, so it will shed a bit more light in terms of whether or not this company is affected and largely given the tensions. Although if you did watch one of our earlier episodes, they are anticipated to take around a 5 billion hit, so it will be good to see what that does in terms of their guidance moving forwards. But so far over the next 4 quarters, they are anticipating strong double-digit growth to the EPS, 100% track record, and if you're someone that likes to look at over the next full accounting period, based on January 2027, they're trading at a forward valuation of 19.6. We'll also briefly highlight for each one of these growth companies the growth grade for Nvidia coming at an A, but most importantly, yes, their year-on-year revenue is very strong, expected to be 60% over the next year, but we should highlight that over the next 3 to 5 years, they're expecting EPS growth of 35%. And we'll end for each one of these companies on the institutions, where for Nvidia we see 66% ownership, 70 billion worth of sales over the last year, but a lot more buying at 401 billion in the same time frame, and more importantly in the most recent quarter, around 10 billion worth of buying, 2 billion worth of selling. Institutions are clearly incredibly bullish on the company. Now we'll also run you through our intrinsic value, although bear in mind when they do release their updated earnings, it will give us a better look at the figure. As you can see, derived from the DCF model, free cash flow year on year, including the most recent annual accounts, 61 billion, which saw an increase of 125% from the previous year. Over the last 5 years, it's grown 153% year on year on average. Over the last 10, 104%. Moving forwards, we've gone 20%, a lot more conservative than analyst expectations. And you can see we have a low, medium and high, 15, 20, 25, and as always the numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others, but based on 20% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 162, which does indicate 53% upside. For those that believe it is way too high, well, growth rate 15%, $115.09. And for those that are a lot more bullish, like the CEO, Jensen Huang, and even the AMD CEO, both of them do believe that data center alone will be a very large total addressable market in just the next few years, exceeding $1 trillion. As we can see, $227, 114% upside, more than a double. But we will do what we typically like to on the channel, take the medium rate. We're not done there, we do add an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode, a buy at $146. And we're not done there, we keep going essentially until it's near the current trading price. And what we're effectively saying in today's episode for Nvidia, you're getting a 35% MOS. Wall Street, we saw the strong buy rating, $172 over the next year, in turn translating to 62% upside. But as always, give us your thoughts. Maybe you agree, maybe you disagree, or in fact you just believe they're a hold. We'll also show you, for those that believe the low rate of 15% is more appropriate, what the margin of safety would be. Now at 10%, pretty much around that level, not far off at $104. And as we said, Wall Street 62% upside, but do give us your thoughts below. Now before we move to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's good in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a copy of 35 severely undervalued stocks. Lots of information for each one, the upside that Wall Street themselves see over the next year, and we will be dropping May's copy very soon, as well as a spreadsheet covering Wall Street stocks that they believe have the most upside in the S&P right now, so click below, you can sign up and read straight away. We continue in the semiconductor space with Taiwan Semiconductors, up 18% over the last year. Year to date, in fact, down 18%, but over the last 10 years, similar to Nvidia, massive outperformance, up 557%. Trading near the 52-week low, a double strong buy from Wall Street and Quant with a buy from Seeking Alpha, and we can see the forward P of 17 does in fact sit below the 5-year of 22.1, so again that in turn a severe undervaluation signal, and we can also see the disparity between where the company sits and the bottom line, as well as the company growing in expected intrinsic price month on month. So again, we do believe this company does look severely undervalued, and they also expect very large growth to the EPS over the next 4 quarters, 100% historical track record, and if you look towards December 2026, they're trading at a forward P of 15.5. Growth grade also looks good at a B+, and in terms of the earnings per share, expected to grow 21% over the next 3 to 5 years, with revenue growth over the next full 12 months sitting at 25%, above the sector at 7%, as well as above their own 5-year at 16.8. What are the institutions doing? Well, they hold nearly 17% ownership, 16 billion worth of selling, pretty much 50% more buys at 22 billion. Then in the most recent quarter in 2025, they bought 3 times as much as they sold, 1.5 billion buying, 500 million selling, so institutions very bullish on TSM. Now intrinsic price gets to $225 as the average of these 3, and if we do look at the current price at 160, you are getting a very respectable MOS, in fact around 30% up to $158. Wall Street themselves, with the strong buy rating, something they've maintained for quite some time, $242, 51% upside, trading quite a lot below their 5-year average. In your own opinion though, TSM, is it a buy right now? We then move on to Shopify, which is up 35% over the last year. Year to date, it is down around 8%, but over the last 5 years, up around 54. In terms of where it sits in the mid to upper end of the 52-week range, we just get 1 buy rating from Wall Street, and this company does trade at a fairly high forward P at 66, although when you do compare it to its 5-year average at 364, it does sit right now 82% lower, but that is something that is very consistent no matter what metric you look at. Shopify at the current price is trading significantly lower than it has done on a historical basis. Whilst the other metrics are looking very strong, they are improving, and they also expect strong growth to their earnings per share. Next full accounting period, they're trading on 2026 numbers at a forward P of 51.7 and a very good growth rate at an A-. In fact, earnings per share growth expected to be 34% when the sector in comparison sits at 14%, and if you want to see their revenue expectation, well, it sits around 23%, a lot higher than the sector at 7%, but it does come some way below their 5-year average of 35%, and whilst we won't get into some of the other metrics, we can see on the profitability also looking strong at an A-. Institutions themselves do hold around 70%. We do notice 9 billion worth of selling, but again around 50% more buying at 12.2, and the same to be said in quarter 1, institutions pretty much buying twice as much as they did sell, so another one that they are fairly bullish on. And our intrinsic value today gets to $116, whereas you can see we've gone for a growth rate of 25% moving forwards, with just the most recent year sitting at 76. Now if you did want to use a lower growth rate, that would in fact be downside, and for those that are a lot more bullish at 30%, 65%, but even with this rate we have used, you are still getting a margin of safety, and in fact as we keep going, you're getting at least 15% up to the $99 mark. Wall Street themselves fairly bullish. We saw the buy rating $122, 26% upside, but let us know your thoughts on this growth stock. Is Shopify one you do believe to be a buy in the current climate? We then go back into the semiconductor space for ASML, down 26% over the last year. Year to date, it is down around 4%, has recovered from hitting its 52-week low. Over the last 10 years, massive outperformance of the S&P, up 514%. Massive pullback from its 52-week high and all-time high at $1,110, with a double buy from both Seeking Alpha as well as Wall Street. We also notice the forward P of 24.8, one of the lowest over the last 5 years, significantly below the 5-year average of 33.9, a potential severe undervaluation undervaluation signal, and that's something that we can also note based on this model. We are seeing disparity between the 2 points, current value as well as the lower end of the expected intrinsic price, one that's only been increasing pretty much from February this year, and as we can see, going further and further away. Now they expect 3 of the next 4 quarters to be growth. Bear in mind, semiconductor industry as a whole is fairly cyclical, and they have a 100% historical track record, trading right now on 2026 numbers at a forward P of 22, and whilst they do get a C+ on the growth grade, they're anticipating revenue to increase by around 10%, above the sector at 7, slightly below their 5-year at 16, and in relation to EPS, anticipating over the next 3 to 5 years, 19%, well above the sector at 13.9, but a little bit below their own 5-year at 22.4. Institutions though holding 26% ownership, 11 billion worth of selling. They bought a little bit more at 11.6, but we do notice around 10 times as much, in fact a little bit more than 10 times worth of buying in quarter 1, 1.2 billion, 96 million sold, so they have been very bullish, at least in the most recent period. Now our intrinsic value does sit just over $1,000, as you can note, based on a growth rate of 14%, which is lower than analyst expectations, and if you are looking at a margin of safety based on this, you probably already realize it is going to be very large. In fact, as we keep on going, not at 40% just yet, but you're getting at least 35%. Wall Street see this $943 over the next year, in turn translating to 43% upside. So in your opinion, ASML, one that is significantly lower than its all-time high at $1,110, a buy, hold or sell. And we'll also show you, for those that believe the lower rate to be more appropriate, you are again still getting a very large margin of safety at 30%, not quite there yet, sitting somewhere between 25 to 30%. Wall Street still upside 43%, and we can even go one step further in today's episode to use the 10% growth rate to show you that this company does look severely undervalued, as in fact we keep on going. You're getting somewhere between 15 to 20% in today's episode based on future free cash flow growth at 10%. As always though, do let us know your thoughts below. We then move on to Datadog, around the $100 mark, down 20% over the last year. Year to date, down 30%. Long-term shareholders over the last 5 years have outperformed the S&P, up 132%, trading near their 52-week low, quite some way away in fact from their all-time highs, $170, with a double buy from both Seeking Alpha and Wall Street, and we can see their forward P sitting around 60 is significantly above the sector. You are paying a 197% premium, but if you look at what they have traded for on average over the last 5 years, it is sitting now 82% lower, a possible undervaluation signal, and that is consistent no matter what valuation metric you look at today. Datadog is trading severely lower than their own 5-year numbers. Now over the next 4 quarters, they are anticipating a drop to their EPS, but they do have a 100% track record, and based on December 2026 numbers, they're trading at a forward P at 48. Now growth does look strong at a B-, anticipated revenue growth this year at 22%, well above the sector at 7%, but we can see over the last 5 years, they've grown at a rapider rate, 41%. And if we look at EPS, expected to grow 3 to 5 years, 23%, sector at 14, their own 5-year though, above at 30.4. Institutions themselves hold 78% ownership, 10 billion worth of selling, 7 billion worth of buying, so actually they've been a bit more bearish than they have been bullish, but in quarter 1 we do notice the opposite, so they've been buying a little bit more than they have in fact been selling. Now intrinsic value gets to $154. If we take a look, we have used a growth rate at 20%. Even if you use a low growth rate at 15%, you are still getting some upside at 11%, but based on 20% moving forwards, you are getting quite a substantial MOS. In fact, at 30%, a buy at 108, at 35%, pretty much where we do see this bang on right now. Wall Street incredibly bullish, $146. They anticipate 46% upside over the next year. And we can also show you at the 15% rate, you are getting around a 10% margin of safety. So maybe this does look attractive, or maybe you're someone that does in fact believe this is a hold or a sell right now. We then move on to the trade desk, which is down 36% over the last year. Year to date down 54%, losing more than half of their market cap in a matter of months. Over the last 5 years though, they have actually outperformed the S&P, up 109%, and not only are they near their 52-week low, but a massive drop from all-time highs at $142. Both Wall Street and Seeking Alpha do give this company a buy rating, although we do notice Quant does give it a sell, and we can see their forward P of 31 is significantly above the sector at 12, 146% premium. But if you look in relation to their 5-year average, they're sitting 64% lower. Again, something that is noted no matter which valuation metric you look at, they're trading significantly below their averages. And whilst we won't get into it today, profitability also looks good at an A-. Now they do anticipate 3 of the next 4 quarters to be growth, 100% historical track record, and they're trading on December 2026 numbers at a forward P of 25.1, with a growth grade looking very strong at an A. In fact, revenue forward looking around 21%. That is well above the sector at 3, but it does come under their 5-year average at 28, with EPS expected to grow over the next 3 to 5 years 53%, well above the sector at 10, but also well above their own 5-year at 29.4. In terms of institutions, they hold 68% ownership, $4 billion worth of selling. They've been buying more though at $5.5 billion, and buying a lot more in fact in Q1, so they have been, and for quite some time, more bullish than bearish on TTD. Now intrinsic value gets to $87, where in fact we have gone for a growth rate of 20%, but very similar to the previous company, even on a lower growth rate at 15, you are still noting upside of 17%. And if we do show you the margin of safety in today's episode, you can in fact see you're getting around 30% at $61. At 40% is where we see the company right now, with Wall Street extremely bullish, $95 price target, they see upside of 79%. And again, we'll show you at the 15% level, you are still in fact getting a margin of safety. At 10%, a buy at 56, at 15 is where we see it. Again, Wall Street may be one of the most bullish they are in the list of stocks today, but give us your thoughts. Have you been buying any of these stocks, or in fact, do you believe the opposite and you believe right now is the best time to hold, or in fact consider selling? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.